Hi, my name is Holly Galbreath. I am the mortgage originator here at Alliance Bank. I've been with the bank for nearly 10 years. Started on the front line as a teller in our Winnemac office and quickly moved my way through different departments, different roles, wearing different hats. This has been one of the most rewarding experiences I've ever had. And I hope that the education and knowledge that I have, I can pass that on to you, and you will gain something from this webinar. So let's move on to our reason why we're here today. I'm going to share some information, and hopefully you'll be able to enjoy what you learn. All right. So buying a home is one of the biggest purchases a person will make in their lifetime. It's really considered a great investment, but it's not there to make you rich. It's building wealth comes from the equity in your home, and how to find out what the equity is, taking that market value minus the funds you would owe on a mortgage loan is the equity that you would have on the home. So one of the things I hope to have you learn today is what is a mortgage and how does it work? For those that maybe need a refresher or are not really familiar with how mortgages work or what kind of options are out there, this is what I would like to share. The other is to share the different type of mortgage programs. There are lots of different types, and it's very important for us to share those options with you. And then, most importantly, how do you prepare to become a homeowner? What are the steps to take, and what are things you can be doing right now to get yourself prepared? And then, how much can you afford? What are some tools and some options you can do to make sure you can afford to have a home? And is it worth renting or buying right now? And then, of course, I would love to share some tips and some what not to do's when going through the mortgage process. These are things that we discuss with realtors and other mortgage lenders of some major key things that maybe you don't realize can affect your chances and qualification with getting a mortgage. Okay, so different mortgages. So a mortgage is an agreement between you, the borrower, and a lender that allows you to borrow money on a home and gives the rights to the lender to hold the home as collateral. And then in the case that you were to default on the loan, the lender can then take the home back. There are many different types of mortgage loans available, and typically the lender is going to be the one that decides which one is best for your situation. So the first two comments that I'm going to share are not necessarily mortgage programs, but can be kind of like an arm off of different mortgage programs that are available. One is, what is a fixed rate? So a fixed rate allows you to pay the same amount of each month for the life of the loan. It can still increase if you're planning on escrowing your property taxes and insurance, but typically you're going to pay the same payment, a principal and interest payment, for the term that is decided. So these are really good options. Like a fixed rate is really good for those that are planning on keeping their loan or the home for a long period of time. And it's also really great when rates are really low or are, even just historically low for that lifetime. And the terms that you would choose that would work best for you typically range between 10 to 30 years. Another option is to do an adjustable rate mortgage. This one is commonly known as an ARM loan. So when you go to Rate Shop, you might see the term ARM. The term for that is adjustable rate mortgage. So interest rate is always subject to change over the term of the loan. And there's lots of different ins and outs to that, but it can change. sometimes the rate for an ARM loan is actually lower than a fixed option for a period of time. And it's also a great option for those that are planning on selling or refinancing in the near future, or those that are able to afford higher interest payments or payments over the life of the loan. You might see this as a marketing tool for a lot of banks right now. With our current rate market we are in, this is something that banks are typically trying to do a special on right now. And how to determine how a rate ARM loan works is, an example is we do a 7-1 ARM, which means the first 7 years the rate will be set, and then on the 7th year, after the 7th year, the rate is subject to change up until the term of the loan. And terms can be about 15 to 20 years on an ARM, and it depends on the lender. Another rate program is a conventional loan. So a conventional loan is not secured by the government. These loans are offered through private lenders, such as banks, credit unions, or mortgage companies. They have different guidelines to determine qualification, and the minimum down payment requirements are going to be dependent on the lender guidelines. So for example, Alliance Bank has the ability to accept a minimum of 5% down in some cases. If you did 20% down on a home, you will not be required to pay PMI, which is private mortgage insurance. And I'm going to go over what that is and how that works later on. It does have a bit tighter requirements when looking at your debt to income ratio and credit scores. Most require a maximum of 43% DTI or a 680 credit score. Okay, so let's move on to, here, just give me a second. So government secured loans. So government secured loans there's a different types. They're secured by different departments in the government. So the first one is an FHA loan. So an FHA loan is secured by the U.S. Federal Housing Administration, hence FHA. The down payment requirements can be as low as 3.5% of the purchase price. The closing costs are lumped into the loan amount and are financed, so keep that in mind as well. Closing costs are typically lower, and I'll go over what standard closing costs are going to be when you're looking at that later on. The home you are interested in must qualify under FHA guidelines. So you're going to check with your realtor to determine which homes could be considered. And then similar to PMI, you would pay MIP, which is a mortgage insurance premium. So you pay part of this cost at closing, included in your closing costs, and then part of it in your monthly payments. Now, it is required over the full life of the loan, which is different than PMI. The other government option is a VA loan. So these are specific to certain requirements and is offered by the U.S. Department of Veterans Affairs. It is for active duty members, veterans, which is dependent on the type of discharge, reserves, National Guard members, and then eligible surviving members of military veterans. There are no down payments required. Now, you can choose to put funds down, though, to get a lower loan amount, and does not require mortgage insurance, so like PMI or MIP. There is an upfront fee dependent on a few factors of the military service, a down payment amount, disability status, or whether or not you're buying or refinancing another mortgage loan. And also if this is your first VA loan altogether. And then another option is a USDA loan. Now, Alliance Bank does not offer this product. However, these are the terms of a USDA loan if you were to look around for options. The home must be located in an eligible rural area. There are no minimum down payment requirements and no private mortgage insurance. And closing costs can be negotiated with the seller of the home to have them cover the cost, also known as a seller's credit. There are different types of other programs. One is a construction loan. I'm not going to go through the details of that. I plan to have a workshop later on to go more in depth with this. This one is a little bit more involved. And then there are first-time homebuyer programs as well. And most of those are for those who have never owned a home in their past life or has not owned a home in the last 3 years. And those also can be covered in grants. So help with, different down payments and different covers of fees. And then you would want to check out housing counselors in your area. They often have resources for those that may need some additional assistance with financing, or they might help you with, reviewing past credit and all of that to help you get where you need to be. And then also down payment assistance programs. A lot to tag into that first-time home buyers. In addition to that, even if you aren't a first-time home buyer, there are still down payment assistance programs through grants and housing counselors in our area as well. Okay, so there is a lot of terminology that bankers use, and I feel it's very important for our clients and our community to know what we're talking about and how it can affect you. So I want to go through some of the main things that bankers talk about when we're talking about mortgages and kind of break down what they are and how you can use them in your decision process. Okay, so a DTI, so when we say DTI, we mean a debt to income ratio. This calculates how much your income covers your monthly debts. Now, this is usually expressed in a percentage. The ratio helps a lender decide if they can lend someone the amount of funds they're asking for, or if we need to counteroffer a different amount, so we could stay within DTI guidelines. It is a really great thing to know how to rough estimate what your DTI is. And keep in mind, each lender uses their own rules to determine what is included in DTI calculations. Here is how you can determine what your estimated DTI calculation can be. You're going to take your total monthly debt, monthly gross income, divided by monthly gross income, times it by 100, and that equals your DTI percentage. So monthly debts include credit card payments, other loans, student loans, and then the anticipated monthly housing payment. Now, that's anything that would show up on your credit report. That is what we're going to look at and calculate in your debt to income ratio, among other small details too. And your monthly gross income is the income you receive monthly before taxes and other deductions. So you might be wondering, why wouldn't we just use the full 100% of your debt to income? Well, we know that there's other unrecorded monthly debt, unexpected debts come up each month, and then you also have utility bills, groceries, car insurance, medical bills that come up that you'll need to make sure you have enough to afford your house payment. So Alliance Bank does require a maximum of 43% DTI. An escrow account. So in some cases, the lender may require you to have an escrow account, or you may choose to do this on your own without being required. When you own your home, you are required to pay homeowners insurance and property taxes at the minimum. An escrow account allows the bank to help pay for those homeowners insurance and property taxes when they come due. Your monthly payment on the mortgage would have both principal and interest payments plus your taxes and insurance premiums included, so that when the premiums come due for both the homeowners insurance and property taxes, there is enough to cover in escrow to make those payments. The benefits to this is that the borrower may find it easier than worrying about paying for those each term, and then maybe saving the headache of making sure they've saved enough money to cover homeowners insurance and property taxes each time they're due. Each year, the lender will do what's called an analysis to see if your insurance premiums have increased or decreased, same with your property taxes. And after the analysis, a new payment amount is scheduled to reflect the change. So, keep in mind what I said in the beginning. You may be on a fixed rate. You'll have your principal and interest payments. Those are not going to change, but it could change your payment if you escrow. PMI. It's often a term that's like, oh, I don't want to pay PMI. Sometimes there's benefits to paying PMI, which is private mortgage insurance. If you pay less than 20% down of the purchase price, a lender may require you to pay PMI. The reason why it's there is to lower the risk to the lender who is making the loan to you. PMI is different than homeowners insurance because it is specific to the loan and not the home. It ensures that if you default on making your payment, the lender is covered with PMI payments. It can increase your monthly payment, and the increase is determined on your loan volume. So that is how we determine how much PMI you're going to pay. Standardly, PMI falls off when the loan to value is at 78%. And you have also paid into PMI for around 5 to 6 years, and that is dependent on where you are with your loan. Keep in mind, paying PMI is not necessarily always looked at, frowned upon. We suggest it for those that maybe are a first-time home buyer and know they are going to have some additional expenses. Instead of putting all their money into their mortgage, maybe they need money to help buy new appliances and, furniture and all the things that go into that first time you step into a new home. So another term is an LTV, which is your loan to value. Loan to value is a similar calculation like your DTI. It is calculated in a percentage. Loan to value is the ratio in which a lender determines how much they can lend you based on the value of your home. So now it's no longer about if you can afford it, it's about whether or not the home's value is there. From a purchase standpoint, the value is the agreed upon purchase amount, even if the appraisal comes back higher. So some realtors may discuss an appraisal gap fee, and I'm not going to go through the details of that, but the understanding that in this market, if the purchase price or what's listed on realtor.com is a suggested price, and so when the appraisal comes back, that's going to really you're going to have those conversations with your realtor. And the best way to calculate what your LTV is taking the total loan amount divided by your home value or purchase amount, times that by 100, and that is your LTV percentage. Closing costs. So closing costs vary from loan to loan. And it also is dependent on the loan program that you are in. Typically, closing costs are around 3% to 7% of the loan value. So we vary, and sometimes I just give you an estimated amount of what that might be. Sometimes it's $2,000, sometimes it's $3,000. It just depends on what they're planning on doing. And there's a lot of little costs that kind of roll into that. And and each lender might have something a little bit different. And some of those is terminology, just understanding what different fees there are. So loan costs have different names. So loan costs is something different than just your principal payments on a mortgage. You're also going to have interest, is what the lender will charge over the life of the loan. This is expressed in a percentage. And then fees. Every lender has something a little bit different. They might call it a processing fee, an application fee, origination fee, or an underwriting fee. These are reflected in your closing costs and are required to be paid at closing. Other charges might include an appraisal fee. An appraisal fee, I'll explain what an appraisal is down the road here. And then the other term is points. Points is a way to lower your interest rate. Simply by paying some interest up front, you can save you interest over the life of the loan. So for example, 1 point is equal to 1% of your mortgage amount. It's also often called buying down your mortgage. This one is pretty important. An APR is the annual percentage rate. Often I'll get phone calls or people will want to look on our website for our interest rates. You also need to make sure you're comparing, when you're rate shopping, the annual percentage rate. Okay, the annual percentage rate is similar to the interest rate, but this is the overall cost of the loan on an annual basis. So it's not just the mortgage amount, but it's going to include all your fees. So it's typically higher than the interest rate, and this is the rate you want to focus on when shopping around, because you're going to want to see what the difference is from the rate and how much fees are involved. So right now, a lot of lenders have the same rate, but you want to see what the APR is too. The other term is a rate lock period. I get that question a lot. When can I lock my rate? So when a rate lock is done, the rate will not change for the time period the lock was done for. So for example, we may do a 28-day lock. It allows the lender to honor the rate lock for those 28 days. If the loan does not close within that time period, the rate would be subject to change. There are options for extensions on an as-need basis, or if things are out of our control, or there's also longer rate lock periods. So if we anticipate the lock not being done within a certain period of time, we may suggest doing a longer lock period. There's often a charge for an early rate lock, and an early rate lock is done before underwriting has all conditions cleared, such as a final appraisal or title work. And lastly is gift funds. So gift funds are funds that were given to you for a down payment on a home. There are some requirements that gift funds cannot be used. Thankfully for Alliance Bank, we accept 100% gift funds on down payments if someone is willing to do that. I would suggest you have that conversation with them and they have that conversation with an accountant or a financial advisor to make sure that makes sense for them. All right, let's talk about our current market and understanding kind of what's going on right now. A lot of talk about, values are climbing and what does that really mean in the mortgage world. So what determines the property value? Location. Location is huge. Location to high-performing schools in that area, access to transit, local jobs in that area, and then growth potential. So what's happening in that area right now that could determine the value. Among other factors also include size of the home and the layout, the condition of the home compared to other homes in that area, and then price of homes that maybe have recently sold or comparable to the size and style of the home. And right now, we know that the demand for homes also has increased in value. So what that means is when there are more buyers than homes available, the market value goes up. And if there's less buyers than homes available, the market value decreases. So simple math right there, we know that the demand is really high, there's not enough homes for a lot of people, and there's more buyers than homes. So right now, market values have increased. All right, this is what we've all been waiting for, the steps to home ownership, helping you make the right decisions to get to where you need to be and ready to purchase a home, refinance a home. What are some things that you can do to get where you need to be today? So the first thing is credit reports and scores. Let's talk a little bit more in depth on what those mean, how they are evaluated as the banker, helping you understand that we're here for your betterment, and credit scores are very important. So we want to share what that means and what you can do to do more. So a credit report or score helps the lender determine how much they can lend and how much they will cost the borrower. It's important to have credit, regardless of what it is. It's important to have credit if you are planning on getting any type of loan in the future. There's a lot of different factors that we look at. Sometimes there's good credit, poor credit, and no credit. Some ways to get credit, there's ways to build it, but some of the terminology is when you have good credit, you have more options. So, taking the steps to build that and do more, and taking responsibility for your credit is very important too, so that you can have more options available to you in the future. It is required by law to be able to offer you an annual credit report. You can go to www.com, annualcreditreport.com, my apologies, to pull that annually. So you can get all 3 credit bureaus, and it's very important to check for not just, things that you've done, but check for new inquiries, fraud, collections that may have had an adverse effect on your credit. Ways to build your credit. One is to take out a secured credit card, and there's a lot of different companies that offer that. Another one is to open a credit builder loan. One of the examples to that is a CD-backed loan. So if you have some funds available, you can do a CD-backed loan so that we can report that to the credit bureaus. And then there's also getting a credit builder credit card. So there are specific credit cards that are specific to that. And then another easy way to do that, especially for young people, is become an authorized user on someone else's credit card, such as a family member or someone that is willing to add you. You don't even have to use the card in order to start building your credit. Another conversation is, what is a FICO score? So actually a FICO score is a trademark system that helps provide lenders with a kind of a conducive score to determine what's poor and exceptional credit based on many different factors. And many employers actually review credit reports, not scores, in determining eligibility for employment. Home and life insurance companies do the same, as well as auto insurance premiums are affected by credit reports. There are many different ways to build it, and understanding what affects your score is also very important. So 35% of the factors look at payment history. This is huge. Don't pay back too quickly, and always pay on time. Late payments will be reflected on your report and significantly affect your score drastically. It can go up and down really quickly when it's 35% of the factors. 30% of the factor is credit usage. So only using a small percentage of your credit limit can really help with that. So having a good balance. And then the 15% of the factors look at length of credit history. Sometimes no credit is as hard as bad credit. So building that time. A lot of lenders look at a 12-month history. So, having a few different types of loans can also help with that. And then it goes into 10% of that looks at types of accounts. So if you only have 3 credit cards, it doesn't affect your credit the way, having different types of loans would do. And then another 10% looks at recent activity. So being very careful that you don't have too many inquiries can also affect your score, and then maybe having too many opened accounts. So if you're not using something like a credit card, as long as you have enough backing, it might be good to close it. And most importantly, you are the only one responsible for taking care of your credit and making sure that you can correct those mistakes. There's a lot of resources to help you along the way. And a reminder, banks are here to help you. We want to see you succeed. And so if we can get this part taken care of, the rest will just fall into place. So how can you determine how much you can afford? So determining how much you can afford, we're looking at whether or not you have a reliable source of income and what is your work history, or do you have a new job lined up? So we look at a 2-year work history, but we understand circumstances change. So we're just looking for stability, see what kind of reliable income you have. We've seen some students, college students that are graduating and starting a new career. They may have a job that's lined up in the next month or so, and we're going to look at what promising state is that as well. And then, do you have a contingency or a safety net for unexpected expenses? We want to see that when you're looking at how much you can afford, you want to make sure you can afford a home. There's other costs that go into owning a home. Can you afford insurance? Can you afford other expenses, repairs that might have to happen in the home? Will you need to buy some new appliances, furniture, or other equipment? Like, think about this, but do you need a lawnmower? These are things that you want to consider when you are planning to buy a home. Also helps you determine how much you're going to put for a down payment. And then the best thing to do is do a spending and savings plan. And this will help you get an overall view of how much you really spend right now, as is. What you're going to do is take the money you take home, so your net pay, okay, in your paychecks, minus the total monthly expenses. Everything you spend right now, anything left over is what you have available for housing expenses. Is it enough? Can you afford that? Are you putting enough into savings still to cover all of these things? So will you need to come back on some of these other things that you're paying monthly on? And then I will show after this webinar a useful calculator in determining how much your monthly payment could be on a mortgage and how much you want to put down. So it's an interactive calculator on our website, and I'll show you how to use it. Next step is also very important, is getting qualified. So being pre-qualified. So there is a difference between getting pre-qualified and pre-approved. Alliance Bank specifically looks at pre-qualification. And so pre-qualification takes the credit report and the application details to determine if the information provided is sufficient enough for a mortgage loan. We do not verify the details with verifiable documentation. That is the difference on a pre-approval. They will request documentation up front to be able to qualify you. However, we do the pre-qualification, and then we get you a letter. The letter is produced that can be given to your realtor, and this is useful in the house hunting stage. Actually, some realtors will tell you that some home sellers won't let you in their home unless you have a letter. So it's very important to have that. After you have gone through the house hunting stage and you find a home that you're looking for, the offer is accepted, a purchase agreement is drawn up by the realtor. And this is when, on the purchase agreement, will also state whether or not you're going to have an inspection done and other details of the purchase. Now, the inspection is not required by the bank, so this is something that you would have to determine and pay out of pocket for those fees. And once you have a purchase agreement signed, the purchase agreement is then given to us as a lender to start the process. So going through that approval process and closing looks like this. So the purchase agreement prompts disclosures and a loan estimate. So the loan estimate has an estimated details of what the loan is going to look like, okay? Once we have those signed, we will request the qualifiable documentation and an appraisal fee. The appraisal fee is dependent on the lender. Typically, it is required to be paid upfront, just as a safety net to the lender as well, that if you were to withdraw from your loan, we are not then paying the appraiser for those fees. An appraisal is a document that provides a professional opinion of the home's value. This is based on comps in your area and other factors that I had already mentioned on the market value page. So the next step is also, so once we get that appraisal ordered, is to order title work and title insurance. The seller is typically responsible for deciding where title work and or title insurance comes from. There are several title and abstract companies in our communities, and usually the seller will determine which one they would like to use. Title insurance is critical for a home buyer because it does protect both the borrower and the lender from the chance that the previous owners didn't have a free and clear ownership of the home, meaning they have a lien or someone has sued them. The previous owners may be responsible for taking care of that, and you are not responsible for that as the borrower, as a new owner. Title work is the documented history of the property, ensuring that the title is clean of any liens that get passed from owner to owner. And usually those get cleared up before we close. Title officers are full of knowledge when it comes to property transfers and anything that needs some legal advice. That's usually who I would suggest you reach out to, as well as they work with lawyers that work with them on documentation. So they have a wealth of knowledge that can help you in that decision process. Especially if you are not using a realtor, I will always suggest you contact a title company to make sure that documentation is correct and legal. So those steps, a lot of it happens on the back end. Now is the waiting game for you. So we wait for that appraisal to come back. We wait for title work to be completed. And once we get all of those things back and everything, you know, we clear all the conditions on our side. You've been in contact with your lender to make sure things are moving smoothly. We've received all of those items back. We will then schedule a closing date and get this loan to the closing table. So usually that last week is when we talk about, you know, how funds are going to be paid. A wire is done usually from the borrower's bank account for the funds they are responsible for paying. Those funds are wired to the title company who is closing the loan. The title company will then disperse the funds to the seller. So there's no transaction with the seller directly. The loan amount that we're responsible for making sure gets to the title company as well is also wired from us. So closings typically happen at the title company or has a title officer represented to ensure that the right documentation is completed and notarized. The lender is usually at the closings as well to answer any questions about bank documents, and the realtor is there as support and hopefully to hand you those keys and get you in that house. So as you can see, it does take steps. A lot of patience is needed during that time. Sometimes there's things that happen, little hiccups here and there that we just We got to work through them, and but our goal is to get you from start to finish in an easy, efficient manner. So some things to avoid while getting a mortgage. So the key thing here is this isn't a, we want you to have those conversations with your lender. So if these things are happening, we want you to talk through them with us and not keep them to yourselves. There's a lot of reasons for that. It can affect your qualification for a mortgage. And these are things I talk to a realtor about. So they're talking to you about it. We're also going to talk to you about it. So first thing is, do not change your employer, quit your job, or become self-employed while you're in the middle of getting a mortgage. Self-employed borrowers, we look at normally 2 years of taxes. So if you don't have that just yet, that could really affect your chances of getting that mortgage. Don't take out any long-term debt, such as a car loan or a furniture loan. I know you're really excited to get in that house and you're looking to buy all of those things. Talk to your lender before you do any of those things. And then do not become a co-signer on a loan. Most people don't really think about this, but this does affect your credit, and it can affect a lot of things. There's a lot of other qualifications that have to be looked at when we see co-signers. And then do not increase your credit card limits. That can also affect your qualifications for a mortgage. And then absolutely do not spend. Right now is time to save a little bit, kind of watch what you're spending, because what happens is when we get closer to closing, now you have some unexpected things that might come up that you're going to need to make sure you take care of. And then do not have any late payments on your debt. It's very important to be on time, and keeping them pretty regular shows commitment and stability. And then another thing that I didn't put in here, but is be consistent on who your financial institution is. So we verify a lot of things with banks that you might have your deposit accounts at. We want to see a stability there. We understand things happen, but being very open on where your financial institution is so we can verify and source out certain dollar amounts, because large deposits will be sourced out. There is no minimum, but we look at larger deposits. We may want to know more about those. And then don't lie. We want to make sure that all the puzzle pieces are together. There are things that the lender is going to do that typically any falsified information or anything left out is going to be uncovered 99.99% of the time, and it makes it much easier if you just tell us up front if there's any scenarios or things that we should be made aware of. We need to know that as soon as possible. We would not want to to have this process drawn out or cause any grief to both the buyer and the seller if any of the things above happen. And just know that, again, we're here to support you, and any doubt, just talk to your lender. We're here to work through different scenarios and maybe help you, and maybe there's ways to get around a lot of that. So we want to be here for you. So benefits when using Alliance Bank. So I did want to put a little plug in here just because you're choosing to come to us for some knowledge. I'd share a little bit about what we do as a bank and how we handle different circumstances. So first of all is we utilize Federal Home Loan Bank as our secondary market for about 80% of our loans. That means we do sell these loans to them for majority of the ones we do. They help us set our guidelines, and they give us the competitive rates that are compared to our peer banks. Although we sell these loans to FHLB, we service all of them through the life of the loan. The client is not going to know the difference whether or not we sold it. That is the difference, whereas some banks are going to sell it and keep selling it, and you're never going to know who your mortgage lender is. You will always know where your payments go to. We do have other options for the government secured loans like FHA, USDA, or VA loans. And those go through our reps with Quicken and Rocket Mortgage. The nice thing about that is I do help walk you through all of that. I can check in with underwriters. They do the processing and they do the closing and they do the servicing. However, I'm still hands-on with that transaction. We are a local bank. We make local decisions. We know what is happening in our communities and understand the current markets we are in. We work hand in hand with our realtors in our communities as well, and then other organizations that get you as a borrower what you need. And we're a full service bank. So we are a small community bank. However, we have big bank options, and we are here to make sure that whether you're working with us on the mortgage side or the deposit side or other departments, we cohesively are able to service you in the best way we can. And another key thing is just knowing who your lender is. Like I said in the beginning, I want to be considered your banker, not just your mortgage originator. I've worn many hats through the bank, so I have a lot of knowledge in a lot of departments. So just understanding who we are people who are in your communities. We are part of your sports teams. And we find that very important when deciding who you're going to work with. You're going to trust us with your monies and making that biggest decision of your life. And I did want to share some of the resources from today. Again, www.annualcreditreport.com is where you can get an annual credit report by law, and we can give that to you. And then check out some more information and my contact information out on www.myalliancebank.com. And then the Play Money Smart through the FDIC has a lot of really great material. It is an interactive game, has some great information and a lot more detail than what was shared today. And for those that maybe need some basic information to some information that even I didn't know, and I was able to learn through that. So very fun game to do and to learn a little bit more about the mortgage world. So lastly, I would like to show you, maybe get out of here. I wanted to show you the mortgage calculator on our website. It's good to see what we're up to here as well. So here is the main page of our website. If you were to apply and you want to get pre-qualified, mortgage tab here takes you to this page where it has a lot of information we just shared today, some commonly asked questions, and some how we review fees. My contact information is right here, and then an online application can be applied now, and you'll go through the steps of getting that included in there. And then down at the bottom of our web page is a calculators tab. This calculators tab, yes, there's lots there. Specifically to the mortgage side, these are the options. There's so many different things that you can be looking at. One might be, what's your mortgage calculator? So you can play around with the different amounts to determine what you feel like you could afford monthly. And this is specifically just your principal and interest payments. And it does explain what each one of those are. Another one that might be very helpful and for those that are a first-time home buyer, deciding whether or not you should rent versus buy. This will help you in determining whether or not you can afford to do it. Well, thank you again for joining me on this webinar. I hope you learned something today and have some takeaways. I am happy to answer any additional questions. You can reach me at hgalbreath@myalliancebank.com or reach out to me via phone. It's 219-563-0666. 0349, and be happy to answer anything that you might have. If you have some additional content that you'd like to learn more about, please reach out to me for that as well. Thank you.